Forex is one of the most popular markets experienced and beginning traders take part in. With a low initial deposit, free trading software, and virtually 24-hour access, it's extremely tempting for people just to jump in with both feet without having much in the way of any sort of training. Now, this is dedicated to some of the best Forex trading tips taken from not only real-world trading experience, but also from the many Netpicks family members who've enjoyed success trading one of our trading systems. So think of it as a checklist that you can follow before you set off on your own trading journey. Now, there are three broad categories that make up what it takes, and these are something that successful Forex traders have not only understood, but they aim to excel at. These three items, when combined, can set the stage for your trading success. Number one, a Forex trading strategy. Number two, excellent money management skills. And three, an understanding of psychology as it relates to your trading. The following trading tips are going to focus on what has a direct effect on your success or your failure. Now, if you need the basics, such as charting information, brokers, or even demo trading, you can download that free information right here. Forex trading tip number one, trading strategy. Now, before we get going, I want to mention something very important. There is no holy grail in Forex or any other market, regardless of what the emails and the marketing websites say. Focus on a trading method that you can understand, replicate, and it's proven itself to have an edge over time. Any system or method based on the mechanics behind price does not totally rely on lagging indicators and can be easily explained is something that you may want to investigate. Now, a trading strategy, regardless of the markets that you trade, should have the following two important variables. A setup, what constitutes a valid trading opportunity, and a trigger. Once the setup occurs, how are you triggered into the trade? Now I'm going to use supply and demand trading to explain what a trading setup is. Now, supply and demand in this regard simply refers to the battle of the bulls and the bears and the imbalance caused by having one group being able to exert control over a market. Now, this is an actual Forex trade setup, and for this tip, I want to use one that actually worked. Now, remember that your trading wins and losses will come at a random distribution. Number one. Now, I use a trend line to show the price traded inside a channel and then spiked up and broke through the top of the line before dropping hard. When this occurs, it highlights an important area to watch if or when price comes back to it. Now, you can see that the drop was pretty fast and hard, which shows an imbalance of buyers and sellers where sellers totally overwhelm the buyers. Now, this is key. Number two. Price takes about 2 days before it drives hard to the bottom of the yellow zone that was started way back at number one. This becomes our setup, although in this instance, a sell limit was set a few pips below the supply area. Expanded trading tips for this chart. The larger time frame for this chart was sitting at a supply level, and our level here is right up against it. Now, buying into a supply level or selling into demand when right on top of it will not be a positive for your trading account. Now, I want to draw your attention to the large green candle. Now, it should be obvious that a large number of contracts were bought to drive price this fast and hard in a 30-minute period. The high represents the last buyer who then saw price plummet and take them into a losing trade. Without a trading strategy, it's easy to justify buying that large candle. With a trading strategy, now what this section of tips is all about, you would not have been a buyer, and this highlights why an actual trading strategy is paramount to your future as a trader. Now, the setup occurred when price came into the zone that we were watching. Now, we just need a trading trigger. In this trade, the trigger is actually price just coming into the zone. Let's say that you need a little more confirmation and require an actual trigger to get you into the move. Now, this is important. Confirmation can often require price moving in your direction, which could increase your stop size, thereby lowering your position sizing. Two trade triggers can be seen on this chart. The MACD is a momentum indicator, and when you see the histogram drop lower, you can use that for your trigger into the trade. This indicates that the upside momentum is starting to lessen. This is not foolproof. Nothing is. But taking into consideration our trade setup and what it represents, it's not a bad play. We also have a mini trend line connecting the lows of the candles, and you may elect to simply short this market upon the break of that line. No entry is the perfect entry, so we can just use what price is showing us. This chart has inside candles, and these same candles don't show with certainty who's in control. Now we can tell the momentum is slacking, and given the nature of the setup, just shorting when the market shows weakness is also a pretty viable trading decision. Now this is not a complex trading method, but has proven to be effective and allows larger position sizes due to the tight stop that's usually used. It has both aspects that we need, a setup and a trigger. So if your trading system does not have these two variables, well, look for a better system. The bottom line, this tip is all about keeping things simple. Don't get too bogged down in confusion. Now the main drawback of this type of trading though is at times people do have an issue quantifying the setups. For those kind of people, a trading system by Netpicks may be something that they might want to consider. All the setups are mechanical with a little bit of art, which means when certain variables are met, you're informed of a trading opportunity. All your targets, your stops, and your entries are printed for you, and that helps keep you consistent in your trading. Forex trading tip number 2, money management. It's not the most glamorous topic, but without a full understanding of risk and leverage, you really run the risk of account ruin. Nobody is able to tell you what risk to use per trade, but the standard quote is usually 1 to 2% of your account balance. So I'm going to add 2 things to that. 0.5% is considered really conservative and allows new traders to take the losses without too much account damage. Consider using the balance plus or minus the P&L of any open trades. This can be an in-depth topic with examples and what-ifs. However, following 2 basic account tips can really go a long way in protecting your account from a string of losses and ending your Forex trading career. Number 1, what you're thinking of risking, just cut that amount right in half. Number 2, ensure that your stops are not just a suggestion, but a demand that will be executed. Now, while the majority of traders simply use their account balance as a sign of success or failure, it really doesn't go far enough pointing out where you can improve. It also doesn't show you where the bleeding is happening with your trading. A free software application is available called the Ultimate Trade Analyzer, and you will see that this software that you can download right now is feature rich. Important trade stats like your profit factor, expectancy, expectations, your wins versus losses. You can learn their characteristics so you can make subtle yet really powerful changes to your trade approach. And learn the best times to quit trading each day with a power of quitting analysis tool that has both your AM and your PM session trades. Tip number 3, mechanical and automated trading have their pluses, especially when you realize that trading psychology wouldn't be much of an issue. We would have no issue sticking to any type of trading, whether it's trend trading or any of the numerous mean reversion systems. Our trades would execute, and either our targets would be hit for profits or our stops would be hit and protect us from oversized losses. And we would risk the appropriate amount for our account size and trading system expectations. Stating the obvious, we are human. We are all subject to emotions and doing things that we know are not good for us. We make excuses why we do things. For instance, taking a few losing trades and then seeing price bounce back, we decide just to ignore the stop the next time that we trade. Now, this one doesn't come back, and then your account gets drained. And this happens all the time. Again, this is such a big subject, and there's really no way to do it justice in a blog. However, what I'm about to say was one of the most important tips I ever received. Why? Because it encompassed so many things, such as following your tested and proven trade plan, using your stops to protect your trading account, ensure that your risk per trade can withstand a string of losing trades, and don't over leverage. And here it is. Embrace the fact that your wins and your losses come in random distribution. That means we don't know if the next trade is going to hit our target or register a loss. In fact, we don't know if the next 3 or 5 trades will win or lose. But what we do know is that it will win or it will lose. So can you see how understanding the basic fact makes it crazy to risk too much on the next trade? Number 1, how it makes moving your stop further from price is not the smart thing to do. 2, how skipping the next setup, even though it's a perfect trade plan setup, is senseless. And number 3, how increasing your risk percentage on a sure thing is a sucker's bet. You have to give yourself a fighting chance with every trading opportunity that presents itself. Embrace not knowing and do everything that makes up smart trading on every single play. You don't know if the next trade will return the recent dollar losses back into your account, so it makes no sense to skip it. You don't know if price will bounce back, so it makes no sense not to honor your stop. You don't know if the next trade will be a loser with slippage, giving yourself a larger pip loss. So it makes no sense to increase your risk. In my opinion, how to trade successfully means doing everything you're supposed to do on every trade. Every trade, give yourself the goal to improve on every aspect of the 3 categories we just talked about. It's really my hope that this assembly of tips really helps refocus you to act and think like a professional trader who enjoys the good life because of doing all the right things at the right time, which is really every time.